Good morning and thank you. I am Vaishnavi Vaiti on behalf of Atmel Strategic Advisors. I welcome you all to the H1 FY26 earnings conference call of Krishca Solutions Limited. Today we are joined by Mr. Len Krishnamurthy Balamanikandan, Chairman and Managing Director. Now I hand over call to Mr. Len to share insights on the company's performance, key operational highlights and strategic outlook. Over to you, sir. Thank you.
Yeah, thank you. Um, Good morning to all our shareholders, analysts, and stakeholders joining us today. It is my pleasure to welcome you to the H1 FY26 earnings call of Krishca Staffing Solutions Limited. When we begin this financial year, our focus was clear: strengthen the foundation we have built over the past 5 years and accelerate Krishca's transition from a high-quality product manufacturer into a full-scale technology-driven packaging solutions company. I am pleased to share that the first half of FY26 reflects meaningful progress on every pillar of the vision. In H1 FY26 was a phase of steady execution, supported by disciplined operations and a healthier product mix and strategic capital deployment. Our standalone total income for the first half reached 92.7 crores, marking 45% year-on-year growth, while our EBITDA expanded almost 58% year-on-year to 15 crore, and our PAT improved to 6.18 crores. These numbers are not just metrics. They signal the strength of our progresses, the scalability of our model, and the demand visibility our business continues to enjoy. Our packaging contract business, which started less than 2 years ago, continues to scale impressively with recurring multi-year contracts. The order wins from Vedanta and the consolidation of contracts with the ESL, Steel, and other customers are strong validation of our technical capability and service reliability and a long-term partnership approach. This division is steadily transforming Krishca into a solution-driven, service-led organization. Our current order book is over 180 crore, with the execution timelines between 1 to 5 years. For the next financial year, we have a confirmed packing contract orders worth 75 crore. And currently, we are in participation in orders worth 150 crore in the pipeline. One of the most defining developments in this financial year has been the continued execution of our cold rolling complex in Chennai, a project that will fundamentally expand Krishca's scale, capability, and the total addressable market. This facility, built with a long-term vision, will enable Krishca to manufacture thin.
Bala sir, we can't hear you.
Can you hear me?
Yes, sir.
Yeah. So this facility, built with a long-term vision, will enable Krishca to manufacture thin precision gauge stainless steel strips and high carbon strips in the thickness range of up to 0.1 mm. A segment with a high margin, technology intensive category where India is currently a major importer. This project is not just a capacity addition. It is an entry into a premium material segment and a step to strengthen our superalloy initiative and a gateway to both domestic and global markets demanding high precision strips. Execution is progressing in line with expectation in this project. With the project approaching its commissioning phases in the coming months, we expect a structural shift in Krishca's revenue mix, margin profile, and export contribution over the medium term. This vision is further strengthened by our board approval to establish Vajra Alloys, our upcoming subsidiary focused on superalloys and high performance materials. This is a strategic extension of our cold rolling mill capabilities and position Krishca to participate in a long runway, high value global market spanning aerospace, energy, engineering, and critical application. Our entry into advanced materials marks the beginning of Krishca's next decade of growth, one rooted in deep engineering, technology adoption, and high margin products. As we enter the second half of the year, we do so with confidence and clarity. We have strong order pipeline, capacity enhancements, a diversifying product portfolio, and our expansion into high value materials position us to deliver sustained and profitable growth. Before we move into further discussions, I want to express my sincere gratitude to our customers, partners, employees, and shareholders. Your trust fuels our ambition. Your confidence strengthens our resolve. Thank you so much for joining us today. I think we can go with the Q&A.
Thank you so much, Bala sir. Anyone who wishes to ask the question may raise your hand or drop your questions in the chat box. So we have first question from Mr. Rishabh Tripathi. Mr. Rishabh, you can go ahead and ask the question. Mr. Rishabh, you can unmute your... Yes.
Am I audible? Okay. Thanks for the opportunity and organizing the Concall and coming on the video call. I think this gives a lot of confidence. That's one thing. I think, sir, I have been following with you over email a lot, but yeah. So first question I have is in relation with the equity dilution. So I have read about you a lot, whatever I can find, sir. I'm not sure whether the news is correct. You were in itself like an equity investor some point of time. So like fantastic results will only convert into shareholder value creation when per shareholder value gets created. So how we are looking in terms of equity dilution? That's first question I have. The second question which I have is like I went through your recently like Vajar alloys that we are trying to enter. So some light on that one, like what are the like key products we are targeting, which alloy base, since there are already player in different alloy base, how we'll position ourselves in the market. So these are the couple of questions, and I think after that I will get back into the queue if I have any more questions.
Yeah.
Thank you, sir.
Yes, thank you, sir. See, to answer your question regarding equity dilution, I know, as you know, we are currently doing a 100 crore plus capex to set up a cold rolling mill, which can produce both high carbon strips as well as stainless steel strips. So this was, only possible with the funds we raised in the last round. Without that a large amount of fund, it would be impossible for us to, even imagine the kind of capex we are doing. And I understand your concern. We don't expect or foresee any further equity dilution in the near future. And we are very confident that the revenue, what we are expecting from the new cold rolling mill and the internal accruals from that project will be enough to, provide enough capital for our upcoming capex plan. And we wanted to avoid any further dilution. And at the same time, we're open to, if any good opportunity comes up. And even if you do any further, equity rise, it will be very minimal, very limited, and without diluting the promoter holding. So let's say in case we are doing anything, I will also do equal contribution, and there will not be any dilution on the promoter holding. And to answer your question about the super alloy, see, it is a very carefully planned project. We've been doing research over the last 1 year, and we are not going all out with the investment. We are doing a close to some 7 crore investment in this new subsidiary, and this funding will be supported at the subsidiary level with a mix of debt and some very limited strategic fundraise. So with that, we can able to start the business in a super alloy. And if you look at the market, it is a very large market. As you rightly said, it is over 10,000 crore plus per annum market. A lot of this market is, with the defense and space, and there is a very good amount of market in commercial and industrial applications also. So our plan is to first focus on the industrial and commercial application, where the criticality is very less. So we identified close to 1,000 crore plus markets and grades and product mix. We also approached various customers over the past 6 months. So based on their, confidence we got from the market only, we are setting up the facilities. So we are just, not going to focus on very critical areas at the beginning. Slowly over time, we will start focusing on defense and aerospace. But the initial first 1 or 2 years will be on the commercial grade of super alloys and special steels.
Okay, thanks, sir. That gives some picture. One quick question is like, I see in the marquee client like APL Apollo is not there. So like, have we lost them as a client, or like what's happening on that regards?
No, they are still there. In fact, our biggest packing contract is with APL Apollo. We are actually doing a new investor presentation. This is time being we uploaded. In that, you will see all the clients.
Okay, thanks. Sir, and we were cash flow positive this half.
Yes.
Okay, and we'll continue to be so, like going ahead, like let's at least till sometime some big capex comes in, we are like planning to have being cash flow positive.
See, our internal plan is to maintain a positive cash flow over the next 3 years. Even
Okay.
though we used in CR Mill and the Vajra, see, free cash flow maybe in the peak of capex might be negative next year in the first 2 quarters. But overall, the cash flow should be positive maybe from the second half of next year.
Okay, sir. I will get back into queue. Let others ask their questions. Thank you.
Thank you.
Thank you. Mr. Harshit, you can go ahead and ask the question.
Hello, am I audible?
Yes.
Hi, sir. Thank you for the opportunity. I just want to understand that what kind of revenues are we targeting from the cold roll unit in FY27?
Yeah, Harshit. So the plant will have a 60,000 tons per annum capacity. We are starting the production maybe from end of May based on the current timelines. So certainly we are expecting over minimum 150 crore additional revenue from the CRM. In a best case scenario, even we can do 200 crore plus also. But for now, at least 150, we are very positive of crossing.
So, sir, this 150 CR will flow in FY27 itself?
Yes.
All right. And so my second question is regarding what is the current bid pipeline in our packaging segment and what kind of conversion are we looking from there?
Sorry, can you say again?
The current bid pipeline in a packaging segment.
Yeah, currently we are doing over 150 crore worth orders under finalization with some 6 to 7 major customers. And we are historically, if you look at our conversion, it is 20 to 30%. So we are expecting the similar conversion in the with the orders in the pipeline.
All right, sir. Thank you.
Thank you.
Thank you. Next question is from Mr. Amitav Vatsya. Please go ahead and ask the question. Mr. Amitav, you can unmute yourself and ask the question.
Sorry. Yeah, I hope I'm audible.
Yes.
Yeah. So my question is related to the last one. Actually, as per annual report of your company, last time the bid pipeline for packaging contract was 750 crore, and you mentioned the similar strike rate of convergence. But the recent investment presentation and you were speaking as well that it is 150 crore. So why the TAM or the bid pipeline has reduced drastically? Any light on that?
See, from the pipeline, close to 250 crore orders we already received. The thing is, there is a big order from Vedanta, it's 107 CR, but they given the PO for only first year. They are not given the entire 5-year PO. They are telling every year PO will be given. So, but we are taking only the 25 crore worth of orders in the confirmed order book we are disclosing in the public space. So that's why I'm saying that 180 crore plus orders already we have for over the next 5 years. In fact, if you look at there are even APL also they given only 1 year PO. So every year they will give. That's the system. If you look at that, we out of that 750 crore, more than 20% orders we already got it. So these what I'm talking, this 150 crore in the pipeline, it's a new orders.
Okay. And if this strategy has changed like from 5 year to 1 year, kind of short-term order, so how does it change our numbers and our pipeline, I mean, production pipeline, and how the margin visibility will be better if you have a short-term contract? From a price variation and raw material costing perspective, it may add, but how do you think from a long-term perspective, I mean, the shift of the timeline, whether it will help us or no?
In the long-term perspective, it is always better to have more packing contracts with 2 to 3 years or 5 years timeline. It gives us stability, to plan the different grades of products or other product items. Apart from strapping, also a lot of other items being used. So we can plan in the long run with the capacity. So short-term orders are always volatile, subject to the current steel price fluctuation. Long-term orders is always better.
Okay, I have one last question with respect to sale order in strapping segment. So far we we just have Bokaro, and do we see any other, I mean, multiplication on the sale front of this order, and when we can have a large order?
See, with respect to sale Bokaro trial order, we are expecting that final clearance hopefully in December. Once that is we got it, we can participate in a much bigger tenders. So that whatever is supplied in the month of March, still we are in the final leg to get the performance certificate. And we are also in discussion with one more large sale unit for a trial order. So in next financial year, we'll be in a position to participate in the open tenders of sale.
And there would not be any differentiation between new player like you and the erstwhile player incumbent. Like, is there any like a railway kind of structure where you are a new source, so you will have a cap of, let's say, 20 crore or 50 crore? What is the eligibility criteria for a new player into a sale order book?
See, the sale tenders are created. It is not favoring any new people. That's why if you look at our brochure, there is a different thickness range and different grades. When in sale tenders, they're asking at least 1,000 tons of supply in a particular financial year in a particular size. So it is that too from PSUs and only reported clients. They're not considering the export and other small clients. So it's very difficult to fulfill. That's why we taken this trial order approach. Once we clear this Bokaro trial order, automatically we will fulfill the criteria, and there is no other further restriction on the participation. Once we cross the threshold, we can participate in all tenders.
Okay, thank you.
Thank you. Anyone who wishes to ask the question may raise their hand or drop your questions in the chat box. Next question is from Mr. Yash. Mr. Yash, you can go ahead and ask the question. Yash, you can unmute your lines and ask the question. We will move on to the next question. Next is from Mr. Paramjit Singh. Mr. Paramjit, you can go ahead and ask the question. Mr. Paramjit, if you're speaking, we can't hear you.
Hello, am I audible now?
Yes.
Okay, so my question is to Mr. Bala. How do we assess your revenue? I mean, basis your order pipeline, and what is the correlation between your, let's say, annual order pipeline and your overall revenues? Because you have many small clients also, right? So when you say we have a pipeline of 180 crores over 5 years, maybe you have a couple of big orders for 1 year. into that. So how do we kind of project your revenues basis your order pipe? Is it like 70% will be from small customers and 30% from large customers? How do you kind of internally assess that?
Yeah. See, if you currently look at our revenue breakup of H1, we got a close to 33% revenue from the packing contract business.
Sorry, 30% is it?
That is 33%. See,
Okay.
I'll just give you a breakup of domestic. Domestic is 91%, around 84 crores. And our export is around 9 CR, 9% of our overall revenue. In the domestic, our packing contract is around 30 crores, the packing contract revenue. And revenue from the direct supply of strapping and other primary packaging material, it is around 53 CR, around 58%. So overall, if you look at domestic, this for packing contracts will move from 30% to 50%, over 50% over the next few years. We are because that gives a good captive consumption of our own strapping. So we wanted to move towards long-term orders. Reliance on short-term orders, there is a very high risk that our margins will be always fluctuating. If you look at out of 100%, our top 10 clients will contribute over 60% revenue. In fact, Vedanta is our top customer. We are expecting close to 35 crore revenue in the next financial year from Vedanta. And with APL and other big packing contract customers, so individually they will contribute 20 crores. So the top 10 clients will always contribute over 60% of the revenue.
What kind of revenue expectation you have for H2 of this year?
Similarly, whatever we have done in the H1, we wanted to achieve similar revenue. We are on track. Of course, we will try for a little more.
Okay. And Mr. Bala, in the previous call, you were saying that there are some order wins or conversions expected in the month of June and July. I guess it was from some non-PSU customers, right? But we did not hear anything in the month of June and July. So was that something dropped or anything, any light on that?
Sir, we got a 107 crore order from Vedanta in the month of August.
Okay.
So that was the one of the big orders I was expecting. And a couple of more orders are still in the pipeline.
And what is your CAGR projections? As in you have been growing mostly pretty good rate, 40-45%. Is that something which is going to be sustainable for next, let's say, 3 to 5 years, given that you have now cold rolling mill as well as Vajra alloys coming up? So is this something CAGR of 40-50% revenue growth possible over next 3 to 5 years?
See, currently, our company, we are desired to have two business verticals. One is the and the other one is the specialty steel vertical. So whatever we are doing, strapping, packing contract, other primary packing materials will be in the packaging vertical. So whatever we have done is till now it is only in the packing vertical, right? So in the future, most of the growth will come from the steel vertical because the capacity is much larger. We will be having a 60,000 tons of installed capacity. And since our focus is a mix of high carbon and stainless steel generally the value. So it is very possible to have a much higher revenue growth in the steel vertical. And we are definitely confident of overachieving whatever we have done in the past, which is close to 40-40% year on year. In the next 5 years, definitely we will be growing at a much larger rate.
Okay, thank you. I'll come back with more questions if I.
Thank you.
So we have one question in chat box from Mr. Naman Gupta. What is the capacity utilization percentage expected from cold rolling complex in FY 2027 and FY 2028 respectively? And his next question is, will the existing CRC project cater to Vajra alloys requirement or additional capex modifications required?
See, in the first year, we are expecting at least 20% utilization overall, because only 9 months will be running. Average 20% we are expecting. And in the second year, at least we want to do 50% capacity utilization. And regarding Vajra alloy, see, there are possibilities. Our cold rolling mill can be used for making strips of super alloys. A lot of people are using from super alloy plates. They are making strips of super alloys, which in turn use for various application. We know there is a possibility, but it is very early to say that. But we don't need any modifications with the existing mill. We can easily do it from the plates to cold roll strips.
Okay. Mr. Yash, you can go ahead and ask the question. Okay, we'll move forward to the next. Mr. Sriram, you can go ahead and ask the question.
Yeah, hi. Am I audible?
Yes.
Yeah, thank you for the opportunity. Bala, just wanted to know, like, what is the company's vision for the next 3 to 5 years? Like, we started as like a strapping material supplier, then we moved on to the contracts, and now we are moving towards like a steel manufacturer. So what is company's vision in the next 5 years for Krishka? How do you see this core business of contract packing materials and contract in the overall scheme of things, and what will be the company in the next 5 years as per your vision?
Yeah. See, if you look at Krishka, we are always a special steel manufacturer. The steel
Right.
strapping is a very special steel, and we do processing of medium high carbon steel. Also, we do a special heat treatment to produce strapping. Okay, but it was used as a consumable. That was the end application. But the process was a highly competitive engineering process. The process of producing strapping, and our expertise, if you look at it, is handling steel, and we designed our own tempering line post our IPO. The second strapping line we designed it ourselves. It is a very highly complex heat treatment process. We designed it ourselves. So our core competency is handling special steel and advanced materials. So that's why the logical extension of that we are putting a cold rolling complex, and that also we don't want to get into a commodity grades. Wanted to focus on where the application critical. That's why we are focusing on thin precision gauge strips. Okay, so even the superalloy is a logical extension of our expertise. So we wanted to focus more on this specialty steel and superalloy from now onwards. The packaging vertical will remain, of course, there, but the focus from next financial year, because we see an excellent opportunity to scale and do much higher revenue. And whatever the team who is handling the packing vertical, it will continue to lead the packing contracts and the strapping organically. So there also will be aggressive. We have a CEO who's with a years experience in the packing contracts and the packing industry. He will continue to head the business. But my personal focus will be driving this new vertical.
Okay. So would it be fair to assume, like, over the next 5 years, we will see Krishka as like a steel supplier, like an advanced steel supplier and a precision material supplier, rather than just a packing material and a packing contractor? Would it be fair to assume that?
Yes.
Okay.
Like I said,
Sure.
we have two business verticals now. Packing vertical will have its own team. They will drive it. And I personally head the specialty steel vertical. But in
Sure.
future, we wanted to be a special steel manufacturer.
Sure. And one more question from my side. This Vajra alloys business, so when will it start contributing to the top line? What is your sense of it?
See, the production we are expecting to start from Q2 next financial year.
Okay.
Yeah, by end of next year, we'll see some good revenue from that.
Okay, sure. Thank you. Thank you. That's from my side.
Thank you.
So Mr. Yash has put his questions in the chat box. So firstly, he wanted to know, as your backward integration projects ramp up, what steady state EBITDA margin band are you targeting for the consolidated business over next 2 to 3 years, and by when you expect to reach that range?
Project is settled and running in a steady state. The EBITDA, it will be in the range of 13 to 17%, including our cold rolling mill and the packing business. But our focus is, the revenue will be much higher. In that kind of revenue, definitely 13 to 16%, we are confident of managing.
Okay, his next question is on the Middle East business. Has pricing pressure from Chinese competitors eased meaningfully? And over next 2 to 3 years, what export revenue share and EBITDA margin do you realistically expect from that region?
If you look at the H1, our exports have actually gone down. We have done only close to 8.8 CR of exports, whereas in the last financial year, we had almost 20 crore plus over the 12 months. So that is due to the margin pressure in the Middle East. A lot of Chinese penetration is there in the last 2 years. That's why we also slowed down our exports. But after having our controlling mill, there we will get some additional margin. With that, we can do some more volume in that region. But overall, we are not very, very bullish in that region in terms of volume. There will be some organic growth of maybe 15-20% year on year, but we don't see any aggressive expansion of our sales in that region. So EBITDA will be in the range of 10 to 12% only in the exports. Compared to domestic, EBITDA margin is always lesser in the exports due to the international pricing scenario.
Okay, we'll take next question from Ms. Ruchi. Ms. Ruchi, you can unmute your line and ask the question.
Am I audible now?
Yes.
So my question is quite in line with the previous one. When we're saying domestic and international, the mix of domestic and international. So I understand 91% comes from domestic and 9 from international. So do we see a shift in the number of percentage?
In the short term, no, I don't see a great progress in the export numbers. Because next financial year, most of the revenue will come from our cold rolling mill in the domestic market. So definitely the ratio will be in that range.
Okay. And considering the global impact, do we have a lot of impact on, like we have a small percentage, but how far will we be impacted with the global condition?
Sorry, ma'am, can you say again?
Yeah, I'm asking, can you hear me now?
Yeah.
Yeah, I'm asking as the global condition currently, right? So how do we see ourselves impacted with the global condition currently?
See,
considering like we have a small percentage in international markets, but still, what could be an impact? Do we have any?
Yeah, there is a drop in export overall revenue compared to last financial year. That is mainly due to the pricing scenario.
Correct, yeah.
So that's why I said we are not very bullish on the export volume because of the current scenario. We could do even 100 crores of exports. We are losing orders only because of the pricing. If there is no other reason, if the pricing is viable, definitely we can do a lot of orders. We are saying no because the Chinese raw material price is very low. It's very difficult to compete with them. And even the Koreans also doing a lot of exports. So there are 2 manufacturers in Korea. They do great numbers. But the reason is our Indian steel pricing, there's a medium carbon steel price is always higher compared to the international market. That is restricting us to do more volume. So after the CRM, there is some advantage, but at the moment I'm not able to commit. We will definitely try. We have the customer base. The people are asking only because of pricing. We are saying no to orders. So if there's a situation comes in the future, definitely it will increase.
Okay, and can you throw in some light on the revenue number, like the margins for EBITDA? Is that?
You were asking EBITDA from the new project, ma'am?
No, the total consolidated figures. Margin numbers, if you could throw in some light for.
In H1, we have a 16% EBITDA.
Correct, yeah, but going forward, like I'm looking in for H2.
H2, see, like we always committed, it will be in the range of 13 to 15%. That is our long-term sustainable EBITDA. So 13 to 14%, it will be in that range.
Okay, and how do we look at the PAT margins?
PAT will be, I think, because of the depreciation and other factors, it would be around 7%.
Sorry, what percent? Can you repeat the percentage?
Sorry, 7%.
7%. Okay. Yeah, and I have a last question around the working capital. So considering we have a lot of CapEx commitments in order for expansion, how are we looking at the working capital? Are we looking for an improvement there?
Definitely, going forward, there will be a drop in working capital cycle. One is the CR business is the cash and carry business. Okay, so currently in our strapping and packing contract, we have almost little over 4 months is the cycle time now, including packing contracts. Whereas in the steel business, it will be much lesser. So when we start that vertical next financial year, our overall cycle will go down drastically. And also, since we'll be using our own CRM for our captive strapping manufacturing, the inventory levels will go down drastically. So I'm expecting close to some 6 crores of inventory will be freed up. So
Okay.
yeah, this is the future, it will go down.
Okay. Okay. And this is the last question. You gave me EBITDA and PAT, right? So I wanted to understand the revenue year on year, how much growth could we be looking for?
Ma'am, last year we committed 25% revenue for this financial year. So we are sticking to that minimum 20% year on year growth will be there.
Yeah. Okay. Perfect. Yeah. Thank you so much for answering my question.
Thank you. Before we move forward to the next question, I would like to request all the participants to limit their questions to 2 each. Thank you. Next question is from Mr. Arav. Arav, you can go ahead and ask the question. We will take next question from Mr. Harshit.
Hello, sir. Am I audible?
Yeah.
Yes.
Thank you for taking my question again. So, sir, just wanted to understand that you said we will do 150 crores of additional revenue from a cold roll unit, and the utilization will be 20%. Is my understanding correct?
Yes. Correct.
So, a cold roll unit can do, what is the peak revenue a cold roll unit can do?
With the installed capacity, we can do 700 CR.
700 here. All right,
Yeah.
sir. Thank you. That's all.
So we have a question in chat box from Mr. Rishabh Tripathi. Are we planning to update the name from Krishca Strapping to Krishca Special Steel to position ourselves accordingly to our vision?
Right now, there is no plans, sir. We will see in the future.
Okay. Given both our supplier and customer are giants, how are we planning to ensure our working capital and receivables stay under control what sort of working capital, inventory, and receivable days we are targeting over next 3 years?
Like I said, our in-house cold rolling mill will help us reduce the inventory of our strapping raw material. That will be one, it will help us little to reduce the cycle. And you are right, customers also giants, suppliers also giants. That's the business model. Currently, we are in the packing vertical. But like I said, once we start the steel vertical, once we do more revenue, overall capital will go down drastically.
Okay.
Regarding the
Mr.
number of receivable days, I'm not able to give an exact figure, but I wanted to reduce it less than 45 days in the future, in the over next 3 years. That is our internal target. Currently, it is 120 days, right? So we want to bring it less than 45 days.
Okay. And Mr. Sunil wanted to know what is peak margin we are aiming at for next few years.
Margin, again, it is we're expecting around 13 to 15% overall, including both the verticals in the long run also.
And what is the expected CAGR in EBITDA for next 3 years?
See, we are sticking to the guidance of 25% minimum growth. You know, the revenue from CRM will be much higher. Maybe in the next year H1 results, I can able to give a exact guidance on what will be the next 2 years year-on-year growth. So still we are yet to start the production and enter the market. So once we do that and deliver some results in next year H1, we can confidently give a much larger guidance. But right now, I'm gonna stick to the similar 20% guidance.
Next question is from Mr. Varun. Mr. Varun, you can unmute yourself and go ahead with your question.
Am I audible?
Yes.
Yeah. Good morning, Bala. Nice to see you. So I have just, since we have been asked to limit ourselves to 2 questions, I'll just quickly ask 2 questions. Following up on previous participant question, as you mentioned that the longer term EBITDA margins we are targeting in the range of 13 to 15%. I just want to refresh myself in the from the previous con calls, wherein I think you have reiterated that we'll be able to sustain minimum 15% EBITDA margin, and on a longer term horizon, as the capacity utilization kicks in from the cold roll complex, we'll be able to increase those margins. So I just want to understand your thesis behind now giving 13 to 15% EBITDA margin. I understand the revenue might increase, so it can have some impact, but any specific reason that you are giving, you are basically revising down this EBITDA margin range on a longer term horizon? So any reason about behind that, sir?
Yeah, good morning, Mr. Varun. See, we are not downgrading our guidance. You know, I said minimum 13 to 15% is in the long run is possible. Anyway, our aim and plans are to deliver much higher margin. That's why we are entering into and grades and alloys, and even restricting our export because there's a very less margin. So we are always trying to diversify ourselves to get a better margin overall. Whole strategic push from our side. But in the long run, like I said, we had to start the production and do some results on the CR mill. That's why we are conservatively expecting at least for the time being. Overall, we are very confident of increasing it, but right now I'm gonna stick to that.
Okay, sir. Yeah, thank you for that. My second question is, as we are slowly progressing ourselves from a packing contractor to a specialty steel manufacturer, so I just want to understand your thesis on what gives you the confidence that we'll be able to do good in the specialty steel segment. So it will be a again a new segment for us. So what give you that confidence? Do you have any, I would say, soft commitment from the industry, or uh, something which you can tell us, which can give us confidence that will, over the longer term horizon, will succeed in this segment? And also, when we enter to the specialty steel segment, uh, uh, do we have any qualification criterias when we start supplying these specialty steel segment, or just or when even before the production start, can you start quoting those products to your users and get the orders, or you have to maybe supply them some demo or some material for the testing, and then you can start closing the orders? How does that work in the specialty steel segment?
Yeah, thank you for the question. It's a very excellent question. Firstly, we have a captive consumption of over 1,500 tons. Right now, we are fortunate. If you see, we have done 1240 tons of average trapping every month. Okay, so we have a good captive consumption out of 5,000 tons of capacity. Already we have over 20% of captive consumption, but that is on the low carbon and medium carbon grades. But we wanted to use the cold rolling mill mainly for the special stainless steel, where we can get a much higher revenue and focus on high carbon strips. I don't mind buying our captive consumption from outside market. Priority is used to get a better results out of the cold rolling mill. So, and apart from the captive consumption, we have also done almost last 2 years, we've done research on various grades, customers, and we have a good amount of commitments from the customers in the commercial grades. A lot of dealers, we are in discussion in the stainless steel vertical, and we have very good quantity of commitments already, because there is not many people are manufacturing stainless steel in the South India. So we'll be one of the companies. So it is very easier to capture the local, Chennai and South Indian market. Like you said, we will not go aggressively on the critical grades. Our aim is to, maximize the utilization initially with the commercial grades, so easy to sell grades. Slowly, over time, we will enter into, critical grades where the approval will take a lot of time. But focus is to now, ramp up the capacity to at least 50%. Parallelly, we will and we have taken expert people in the industry who have over 30 years experience in the stainless steel and high carbon steel. We've been working with them for the past 2 years. So with the team's expertise and the kind of machines we are installing, confident of definitely achieving our plans.
Okay, sir. Thanks. That give us some clarity. Just one quick question, sir. I understand that this Ministry of Steel and Heavy Industries, they have launched the third round of PLI scheme for the specialty steel. So do we have any plan to apply for that, or are we eligible to apply for that, which will that will start commencing from next financial year? So by any chance, do we have any plan to apply for that?
Yes, we have plans. In fact, our current cold rolling mill, it is exactly falling into the one of the items mentioned in the PLI scheme. We are working on it. We are planning to apply for that for the cold rolling mill. Even Superalloy is also mentioned. We are still analyzing whether to apply for the Superalloy, because there is a minimum 50 crore investment criteria. We are working with some consultants on that front. So for Krishca, we are definitely applying, but for Superalloy, we are yet to decide.
Okay, fine, sir. Thank you very much for answering the question, sir.
So we will take one last question from Mr. Yash Naik. Within our newer primary packaging products, what is the current revenue and margin contribution, and which 1 to 2 products do you see as the biggest growth and margin levels over the next couple of years?
In the first one, from domestic primary packaging, we have done around 4.26 CR, around 5% of our domestic revenue by overall revenue, 5%, it is from primary packaging sales. And in the exports, around 2 crores from primary packaging. So close to, we are doing about around 6.2 CR revenue from primary packaging. This is mostly trading. We are not doing much manufacturing into that. We are doing some job work and doing some trading. But right now, we are setting up a desiccant manufacturing plant with a 2 crore investment that will have over 200 tons of per month installed capacity. So in the next 2 years, I'm expecting more revenue for the desiccant production line. That could be up to 20-25 CR, maybe in the third year or fourth year.
Okay. With this, I would like to thank Bala sir and Ms. Diya Venkateshan, Company Secretary, for providing valuable insight and guidance. And thank you to all the participants joining the H1 FY26 earnings conference call of Krishca Staffing Solutions Limited. We truly appreciate your time and continued interest in the company. For any further queries or clarifications, please feel free to reach out to us at info@acmeladvisors.com. Thank you, everyone.
Thank you, everyone. Thanks for your time. Appreciate it.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.